What's up everyone, my name is Ale. Welcome back to my world of stocks. So in today's video, I want to quickly give my opinion on 5 very high yield dividend stocks that are all yielding like above 6%, but their stock prices have actually crashed by huge amounts. Most of these have actually lost over half of their value. And as a result, a lot of you have been leaving me a lot of comments asking me to share my opinion on all 5 of these. So we're just going to do kind of a rapid fire in today's video, and I'll let you know if I think there's any potential, any kind of hope left for any of these, or if I just don't like any of them at all. Should be a very fun video. Make sure you hit the like button if you enjoy this, and let's go ahead and get started. Okay guys, starting with stock number 5 that I frequently get asked to share my opinion on, that's going to be Kraft Heinz, ticker symbol KHC, who makes famous products like Kraft mac and cheese, Heinz ketchup, Oscar Mayer meats, Capri Sun juices, Lunchable meals, and more. Now tossing them up on our list, we can see that from their 52-week high, they are currently down by 59%, and that leaves them with a dividend yield of about 6.2%. Now taking a look at their longer term performance, they've tanked by close to 70% over the past 5 years, with 2019 alone leaving them down by over 40%. Now last year they reported a drop in net income from positive $10 billion in 2017 to negative $10 billion in 2018, mostly due to a $15 billion write-down of some of their biggest brands like Kraft and Oscar Mayer, meaning that they're just not worth as much as they previously thought. Ultimately, consumer trends have been largely shifting away from unhealthy foods in favor of more healthy alternatives, and the lack of innovation from Kraft Heinz has left them struggling to adapt. In fact, their sales for the first half of the year have dropped by almost 5% year over year, while both their operating income and their net income dropped by over 50% each. So those are huge drops, and this is obviously a company that continues to perform very poorly in a downward trend. Looking ahead, it doesn't look like things are expected to get a whole lot better, as Yahoo Finance estimates that they'll see their revenue drop by 3% this year and then only slightly climb by less than 1% in 2020, despite following a very poor performing year. On the earnings side, they expect the negative EPS growth to continue at least until next year, where they are only expected to grow by less than 1%. The only bright side to all of this is that the stock's valuation has gotten a lot cheaper, as their non-GAAP forward PE ratio now sits at less than 10, which is about half the sector median according to Seeking Alpha. It also leaves them with a pretty high dividend that yields over 6%, although investors are likely skeptical of Kraft cutting that dividend in the future, given that they've already done so earlier this year. In any case, Kraft does think that they can turn things around, as they've hired a new CEO last month that spent decades working for Anheuser-Busch and is often praised for his strengths in building brands and turning their business around in China. On top of that, Kraft has made a couple of notable acquisitions like Ethical Beans, which is an organic coffee maker, and Primal Nutrition, which is famous for their paleo-friendly foods and condiments. But for me personally, this just isn't a stock that gets me really excited, because I don't use a lot of their brands. And on top of that, I think they will continue to see added pressure from private label brands, store-bought brands that offer the same or similar products at cheaper prices that will ultimately hurt Kraft Heinz sales or their margins if they want to compete with them on price. So it affects their profitability as well. Now, thinking long term, I think that Kraft Heinz is a very big company. They can continue to make these smaller acquisitions like they're doing now, and I think they will ultimately be able to recover in the future. But in the short to kind of medium term, I just see too many issues, and I'd rather the company actually start to turn things around before I actually invest in them. But that dividend and the valuation both look very attractive, so I will be keeping a very close eye on this stock, and I'll let you know if I decide to change my mind and invest in them anytime soon. Alright guys, moving on to stock number 4, that's going to be PetMed Express, ticker symbol PETS. And this is actually the world's largest online pet pharmacy, and you might know them as 1-800-PetMeds. Is kind of how they got famous. Okay, tossing them up on our list, we can see that they're currently down by about 60% from their 52-week high, and their dividend yield is now as high as 6.5%. Now, they're actually up by 10% over the past 5 years, but more recently they climbed to almost $60 a share before nosediving all the way down to just $15 a share, which is a drop of around 75%, with 2019 alone seeing them down by over 33%. Now, I actually love the market that they're in because people love to spend ungodly amounts of money on their pets, and this can be a great thing for pet products companies, especially when it's medicine that the pets actually need rather than all the other junk that people buy to spoil their pets, which according to the American Pet Products Association, they estimate that the US pet industry alone was worth over $72 billion in 2018, having climbed by billions of dollars almost every single year since the 90s, and despite most of that being attributable to pet food, the supplies, medicine, and vet care segments together make up over $30 billion in sales. For context, PetMeds only did less than $300 million in total sales last year. So what exactly went wrong? Well, it all has to do with increased competition from sites like Chewy, ValueVet, Allivet, and even Amazon, who consistently offer discounts on most pet medications and supplements. Even brick and mortar stores like PetSmart and Petco have begun selling similar products online. All of this has hurt PetMed's growth as they dropped from double-digit revenue growth in 2017 all the way down to just 3% growth last year, and if we throw in future expectations from Yahoo Finance, that growth is actually expected to drop to negative 3% this year before recovering to just 2% growth the year after. But even then, because the increased competition has forced PetMed to offer lower prices, it has also hurt their margins and profitability, with their EPS expected to plummet by 44% this year before returning to growth of 18% in 2020. In any case, this does leave them with a more attractive valuation as they trade for less than 14 times forward earnings, and it also leaves them with a mouth-watering dividend of over 6.4% yield, with not too high of a payout ratio and a double-digit 5-year growth rate of 10% with a decade of consecutive growth. However, when I was doing research for this video, I read through their latest earnings report, and they mentioned that while they do plan to continue paying the dividend, the board will be reviewing it every single quarter after looking at their financial performance. That's kind of scary because their profits are already expected to be cut like almost in half this year, and if the horrible performance continues, then I'd have to assume that that dividend will eventually get cut. So there's just too much risk for me to get involved in this stock at this time, but it's another stock that I will definitely keep a close eye on. Okay, now those last two stocks were ones that I'm not very bullish on myself, but this next one is one that I've actually started to buy recently after they crashed, and this is one that I'm turning into a long-term position. And that company is, of course, AbbVie, ticker symbol ABBV, which is a biopharmaceutical company. Okay, so they're currently down by 37% from their 52-week high, and their dividend yield sits at 6.7%. Now, in the past 5 years, they're technically up by 16%, but more recently, this stock has crashed by a gigantic amount, as they used to trade above $120 a share, but have since dropped all the way down to just a $60 range, which is where I've decided to finally start buying the stock myself. Now, much of this crash is due to their best-selling drug called Humira losing patent protection in Europe, which has led to the drug's revenue dropping by 6% year over year in their last quarter, and even more internationally at 35%, although it did actually climb by almost 8% in the United States, but that's because it still has protection here, which is actually ending in 2023, and that spooked investors into selling out of the stock. It has also led to their sales this year only expected to grow by 1% and less than 5% next year, with EPS growth of 12% this year but only 4% next year. However, I'm more on the bullish camp for a few reasons. The most obvious is that their valuation is now a lot more reasonable, with their forward PE ratios, both GAAP and non-GAAP, being only around a third of the sector medians, and it also leaves them with a great dividend yield that is getting pretty close to 7%. And while there is a lot of skepticism surrounding their recent acquisition, I actually like the move because it expands their portfolio and it lowers the ratio of sales from Humira from 57% down to less than 40%, while also bringing in billions of more dollars in cash flow. And that adds to the $12 billion from AbbVie that is expected to grow to around $20 billion in operating cash flow in just a few years, all of which may help sustain that mouth-watering dividend and, more importantly, help them pay down their massive debt that only got even worse with the acquisition. But on top of that, AbbVie still has other promising drugs in the pipeline, like their blood and cancer treatment drugs that grew by 38% last quarter, and a number of drugs that are expected to do billions of dollars in sales in the future. If you want more information on that, make sure you check out my AbbVie video, and I'll have it linked for you down in the description. In any case, I still consider AbbVie to be a very high risk stock, and the crash in the price obviously reflects that. But in terms of my portfolio, I'm only willing to make it about like a 5% position of my portfolio, and so far I'm close to like 1%, so I still have a lot of buying left to do. But I'm hoping that all the recent recession talks and the overall trade war continue to flush down the market, and I can get this stock even cheaper. If I can get it with a dividend yield of like 7% or maybe even close to 8%, that would be fantastic. Okay guys, moving on to stock number 2 of the 5 that you guys really want my opinion on, and that's going to be Ford, ticker symbol F. This is obviously the US automaker. Well, we can see that they are only down by 16% from their 52-week high, with a very high dividend yield of 6.7%. However, in the past 5 years, this stock has been absolutely destroyed, dropping by close to 50%. And that's despite having a rally this year of more than 15%. Turning to their valuation, they trade for just 7 times non-GAAP forward earnings, which is well below half of the sector median, and their PEG ratio is also extremely low at less than 0.5. As I mentioned earlier, their dividend is very high at 6.7%, although automakers usually get crushed during recessions, so I wouldn't put too much faith in that dividend surviving the next one. In any case, the stock has been struggling mostly because of a lack of growth. While their sales have actually gone up in recent years, as growth percentages, it's only growth of around 1 to 3% a year. And that's not entirely Ford's fault, as the automotive industry as a whole has pretty much plateaued in recent years, unless you're looking at electric auto sales, but that's something that I actually do blame Ford for, because they have still yet to release anything in the same universe of comparability to Tesla. In fact, their lack of innovation has led to analysts actually projecting a drop in sales both this year and even in 2021. To be fair, it looks like Ford is finally starting to invest in electrification, as they're currently spending $11 billion to electrify some of their best sellers, like their Ford F-150 truck, which has been the best-selling truck in America for the past 42 years in a row, and an all-electric Mustang-inspired SUV, both of which should perform well given that it's the 2 best-selling categories in the United States. And it also sets them up perfectly to compete with Tesla's upcoming pickup truck and crossover SUV, so I'm glad that Ford is finally willing to stand up for itself instead of just handing the market over to Tesla. But even then, I just like Tesla more than Ford because I think they're just so far ahead of the competition on performance, technology, and infrastructure. Now, having said that, I do think that Ford will have a brighter future over the long term. I like the moves that they're making, and I really like the dividend and the valuation. I'm just a little worried about the next recession because automakers will get crushed when that happens, and I think Ford will probably end up cutting that dividend. And because I don't really need this, it's not like I really need Ford stock in my portfolio, I can actually be a little patient with this one and wait for maybe the next recession to pick it up at even lower prices. But it's definitely a stock that I continue to watch, and I can definitely understand why people would want to invest in Ford. It's just not really for me at this time, but I'll let you know if anything changes. Alright guys, finishing up here with stock number 1. This is one that I'm very interested in because they just had a flash crash of over 20% in a single day after releasing earnings, and I've been getting a ton of comments from you guys asking me to share my opinion on this one because it's a stock that I've actually never covered before on the channel. And that stock is of course Tapestry, ticker symbol TPR, and they're famous for being behind some very popular luxury brands like Coach, Kate Spade, and Stuart Weitzman. Okay, now they're currently down from their 52-week high at a massive 63%, and their dividend yield is also the highest of the list at 6.9%. Now, they used to trade for about $80 a share back in 2012, but have since crashed all the way down to less than $20 a share, which is a drop of around 75%. More recently, they're down by 46% in the past 5 years and crashed by 22% today after reporting earnings. Speaking of which, earnings weren't exactly horrendous, they did report net income and EPS down from the previous year, but that was due to a one-time benefit from tax reform. Adjusted EPS was actually in line with expectations, and revenue still grew by 2%. However, the real issue was guidance, as they expect the next quarter's revenue and profit to decrease year over year, while analysts wanted to see a 10% rise in EPS and a 4% rise in revenue. Another concern is that they've been struggling to sell their Kate Spade brand, which has created a lot of backlog in their inventory, and as a result, they recently hired a designer from Gucci and Michael Kors to revamp their designs and kind of appeal to a bigger market. But it looks like the efforts aren't really paying off, as the company noted that their financial results in the brand did not meet company expectations, and more time is required to improve the business, which they claim faces more competition in the retail environment. For context, the brand still grew net sales by 6%, but global comp sales actually fell by 6% as well. Meanwhile, their biggest brand in Coach, that makes up the majority of their sales, is still growing, but very slowly at just 2% this quarter. Their newest high-flying brand in Stuart Weitzman grew sales by 17%, but it's only a small fraction of sales and is much less profitable. In any case, the issue seems to be with how slowly the company is growing, but even though the next quarter is expected to be a decline, they're still guiding for a low single-digit revenue growth in the full year, with EPS being flat. That could be a concern for the sustainability of their dividend, but even at these really high levels, their payout ratio is still just a little over 50%, which isn't very crazy for a 7% dividend yield. And while that dividend hasn't been growing lately, it's at least been paid for nearly a decade now, and at its current levels, it doesn't really need to grow to still give you a nice return. And with the crash in the stock price, their valuation is dirt cheap now, with all of their PE ratios sitting at either half or less of the sector medians, and their PEG ratio is extremely low at just 0.7. Not too bad of a price to pay for a company doing hundreds of millions of dollars of net income. But for me personally, this just isn't a stock that gets me really excited, because I'm not really into the whole kind of women's fashion market, and I don't really know much about it. I'm very uneducated in that market, so it would be hard for me to measure their competition and see what they need to do to really compete in that space. But if I was into all that kind of stuff and I really liked Tapestry's brands, then I would absolutely be buying up this stock at these levels with that mouth-watering dividend. Although I'd have to assume that that dividend probably gets cut during the next recession, but who knows when that is. Either way, it's definitely a stock that I will keep a very close eye on. And if I happen to change my mind and invest in them, if I happen to do some more research and learn about the market and feel more confident in the company, I'll definitely make an update video. Alright guys, that does it for today's video. I hope you guys enjoyed it. By the way, if you want to see a video on like more bullish dividend stocks that I believe in for the long term, let me know in the comment section or by hitting the like button. I'm thinking about doing a video like that for the future. But anyway, thank you for watching. I hope you guys enjoyed the video. Leave your thoughts and comments down below. I'll catch you guys in the next one. Take care. Bye-bye.